Hello everyone, welcome back. So in the previous lectures, we explored how interest rates vary across different debt instruments due to the differences in credit risk. And today we turn to another key question. Why do interest rates differ by maturity even when bonds have same credit risk, liquidity and income tax considerations? This brings us to the concept of term structure of interest rate, which is crucial for understanding bond pricing and market expectations. For businesses and investors, the yield curve signals likely movements in inflation, monetary policy, and economic conditions. It also supports decisions on debt issuance, investment timing, and financial planning. So, in this session, we will examine why bonds with identical risk and liquidity consideration and income tax consideration can have different yields based on maturity. So, in order to answer this question, we will be discussing three major theories of interest rate. One is expectation theory, second one called segmented market theory, and the third one is called liquidity premium theory. So let's begin with a simple but powerful question. If two bonds are identical in every aspect except maturity, why might their interest rates differ? So to answer this, let us move systematically. The first one, I repeat the question here. Bonds with identical risk, liquidity and tax characteristics. That means any debt instrument. If you're taking, for example, Government of India issued debt instrument. You know that Government of India issues different types of debt instruments starting from treasury bills, that is less than 1 year, 91 days, half yearly, 1 yearly, less than 1 year, like that. Plus, the government also issues long-term bonds, including 10 years, 30 years, like that. So, what the difference is that if you notice, for a 6 month treasury bill, that the debt instrument issued by the government of India, it carries a yield, annualized yield, for instance, 5%. Whereas a 10-year bond on an average carries yields 8%. There is a annualized rate of interest. Then the issue here is that both this debt instrument, both are issued by Government of India. That means it has identical risk and the liquidity also same and tax characteristics are also same. Then why a 6 month treasury bill, the annualized rate of interest is only 5%, whereas a long-term bond is yielding a much higher rate of return. For instance, here 8%. So the only difference that we can see here is that one, the 6 months, that is a short-term maturity period. The other one, the 10 years, obviously you know that is a 10 years maturity period. So the only difference is that the time remaining to maturity is different. So then the question comes, why so? Because it's an annualized rate of interest. Why a short-term debt instrument is yielding low annualized rate of interest, whereas a long-term bond is yielding a much higher annualized rate of interest. So to understand this, let us introduce a concept, the concept called yield curve. Which has been widely used in economic and financial discussion. So this is a plot of the yield on bonds, that is the rate of interest, with the differing terms to maturity, but the same risk, liquidity and tax consideration. So in general, we get three kinds of, based on the slopes of the yield curve, we get three types of yield curve. One is called upward sloping yield curve, that is long-term rates are above the short-term rates. And the other one is flat, where short and long-term rates are the same. And the third one is inverted yield curve, where long-term rates are below short-term rates. So maybe in the beginning you may see that what does it mean actually the long term rates are above short term rates. When I show you a figure, a yield curve, and you'll get, I am sure you'll get the idea much clear. So look at this curve. This is a yield curve we plotted for US Treasury, the debt instrument issued by US Treasury. So important things to remember. Let us just look at this diagram. This one is the yield on 14th December 2017. So before going to that, interpreting this date, first let us recollect the definition. Yield curve is a plot of the yield on bonds with differing terms to maturity but the same risk. That means if you are plotting a yield curve, the issuer should be the same kind of issuer. For example, here we are only taking US government. Only the difference here, and the liquidity is same, tax considerations are same. The only difference is that we are taking different debt instruments issued by the US government. One is, for example, 1 month. This is on the date. Just take the date, for instance, here, 14th December 2017. On this particular day, what is the yield for a 1 month? A 1 month US government security. What about the return for a 3 months and 6 months and 1 year? Then you can see here the 10 year. For a 10 year, what is the return? And for 30 years, what is the return? So what you can see that, sorry, here we should go to this red line note here. This one. Okay. So what you can see that each and every point along the x-axis, what is mentioned is the maturity period of the bond. On the y-axis, you can see the yield or the rate of interest. So if you go through this line on the particular day, that the 14th December 2017, a 1 month US government security yields approximately 1.25 rate of interest, whereas a 30-year government security issued by the US government, it yields 2.71. That is the annualized return. Even for the 1 month here also, that is annualized return. Annualized return is 1.25, whereas for a 30-year US government security yields 2.71. So then 1 year before, for the same types of government securities, when we take the yield, for instance, you can see that on 14th December 2016, the rate of interest for a 1 year government security was 0.5%, whereas for long term, this one, for example, 30-year government security, the rate of interest was 3.14%. So you see the difference. This actually 1 year before and 1 year after. In 2016 December and 2017 December, the same kind of instrument, you can see that over time, you can see that there is a difference. For the same, you can see that here the difference is 0.75. That is the rate of interest difference, right? So what the more important thing is that when we talk about yield curve, we just think about the one yield curve. For example, this one, which I am mentioned, this red line. This is the yield curve. It is plotted on a particular date. On a particular date, for instance, for example, here 14th December 2017, you know that this is the yield curve for US government security. So this, I am repeating this point, it has same risk, it has same liquidity, it has same income tax concentration. So the point here is that the term structure, term means the time period, integrates the market's anticipations of future events by offering a complete schedule of interest rates across time. So here I have shown you two yield curve, one for 2016 December, other one is 2017 December. So again, you can see here is that even for the short term, we have noted that for the 1 month security, 1 year before it was only 0.5%, but 2017, after 1 year, the rate of interest became 0.75. Whereas for the 30-year bond, 1 year ago, it was 3.14, but after 1 year, when government issues for the long term, they need to pay only 2.71% as the rate of interest. So some important points to note: the yield curve of US Treasury here includes T-bills, T-notes and T-bonds all together in one yield curve. And another yield curve can be of AAA corporate bond. Again, at that time, instead of this US Treasury yield, we will be saying AAA corporate bond, because that is the same risk. Again, we will be plotting the corporation issuing short term, medium term, long term, all in one curve. So yield curve can be constructed every day. Every day, whenever US government issue a new security, or on that particular day, if already issued bonds, what is the say rate of interest for different terms of securities. Every day, the date of issue of the new bonds or bill, including short term, medium and long term bonds. So in the long run, so the idea here is that what we have done here is that we are now narrowed down to the key point. The only difference between a 1 month security and a 30-year security is that only the time period. One is short run, other one is long run. So what are the risks in the long run? So in the long run, there is interest rate risk, there is inflation risk, and there are liquidity concerns, because the short term, for example, the short term can be easily traded as compared to long term. So to understand this term structure of interest rate, I already mentioned in the beginning that we have three theories. So a typical theory, an ideal theory of term structure of interest rate must explain the following facts. One, we have seen that interest rates on bonds of different maturities move together over time. When short-term interest rates are low, yield curves are more likely to have an upward slope. When short-term interest rates are high, the yield curve are more likely to slope downward and be inverted. Yield curves almost always, in general time, during normal period, normal economic conditions, yield curve almost always slope upward. That is, the long-term yields tend to be higher than short-term yield. So in other words, when we are having a upward sloping yield curve, what does it mean? That the short-run rate of interest are less than long-term rate of interest. So you can see that here, for example, 1%, but here is 5%. So that means this is the maturity period. This is 3 months, for example, 3 months. This one, for example, 10 years. So what you can see here is that since with the moment we say that yield curves almost always slope upward, what we mean that the short-term rate of interest is less than long-term interest rate. So these are the three key facts we should be, the typical theory should be able to interpret. So here I'm showing you another figure. This is issued by the US government. But I am showing you two debt instruments. One is a 3-month treasury bills, other one is a 10-year treasury bill. So this is not an yield curve. Why? Because here what we are seeing that for each debt instrument, for example, a 3-month treasury bill, the blue line, this one, we are plotting across the years. Right, so you can see the rate of interest movement. Similarly, for a 10-year treasury bill, that also we have plotted over across the years. So here both are issued by government of US, same government, but this one we are plotting against the time period. But a yield curve is like this one. So here, for example, which is the one I mentioned, this one, for example, this particular point denote this 3-month treasury bill, and this 10-year, this point, this one denote this green line, this figure, but on a particular date. Here the date is 2017 December, but at the same time in this figure we have years across on the x-axis. So as I mentioned, to understand why a term structure of interest rate, why interest rates vary across different maturity period having debt instruments. To explain this, we have three theories. One is called expectation theory, second one is called segmented markets theory, and third one is called liquidity premium theory. So let's begin with the expectation theory. So as per the expectation theory, interest rates on long-term bonds equals the average of expected future short-term interest rates over the bond's life. So investors view bonds of different maturities as perfect substitute. For example, they consider a 1 year versus a 10-year security, maturity having security. They are perfect substitutes. So the yield curve reflects here the market expectations about the direction of future short-term interest rates. So let us explain what is this theory is all about. To explain this one, let us consider two investment strategies. One is purchase a 1-year bond, and when it matures in 1 year, purchase another 1 year bond, that is at the end of the first year, right? That is one strategy. So here ideally you want to invest in both years, but what you are doing that you are purchasing a 1-year bond, and when it matures in 1 year, you purchase another 1-year bond. And the second investment strategy is that you purchase a 2-year bond and hold it until maturity. That means at present itself you buy a 2-year bond. So suppose the current rate on 1-year bond is 6%, and you expect the 1-year rate next year to be 8%. So then the expected return from the next two 1-year bonds equal to the average of the first 1 year and the expected rate of interest in the second year. That is, first year we said that this is 6%, second year we said that is going to be expected rate of interest for the another 1-year bond in the second year is going to be 8%. So in this case, the average when you take the annualized rate of interest is here, the average, that is 7%. Therefore, the interest rate on a 2-year bond must also be 7% to make you indifferent between the two strategies. So put it in with a simple example. Assume an investment of $1. So I have given the explanation for that. Today's interest rate on a 1-period bond, interest rate on a 1-period bond expected for the next period, and today's interest rate on the 2-period bonds. All the three data points are given to you. Then according to expectation theory, the rate of interest is going to be the average of the annualized rate of interest for the first year, the annualized rate of interest for the second year divided by the number of years, that is the 2, right? So here the interest rate on a 2-year bond must equal the average of the current 1-year rate and the expected 1-year rate next year. So the key insight here is that the return from holding a long-term bond to maturity equals the expected return from rolling over a series of short-term bonds. So if we put it a little bit more systematically here, so I have one figure to show you here, the 1-year interest rate today, 1-year interest rate 1 year ahead, and 1-year interest rate 2 years ahead. Then the 3-year annual interest rate is the average of 3 1-year interest rate. That means this one. So now we have the second theorem. Second theorem is called segmented markets theory. So here, unlike the expectation theory, here bonds of different maturities are not substitute at all. Because in the previous theorem, we said that people are indifferent between short term and long term. But here, bonds, there is a clear, they're not a substitute at all. Investors have strong preferences for bonds of one maturity over another. In other words, market for bonds of different maturities are completely separated and segmented and cannot be substitutable. So there is a clear distinction between short-term bonds and long-term bonds. So investors prefer their portfolio to be liquid and thus will prefer short-term bonds over long-term bonds. So demand for short-term bonds increases. This higher demand, you know that when the demand for bonds increases, it price increases, and but the rate of interest decreases. So here, if people have a strong preference for short-term bonds, then you know that there will be a high demand for short-term bonds. Then as a result, there will be increase in the bond price, and then there will be a decline in the rate of interest for short-term bonds. In contrast to this, you know that for the long-term bonds as compared to the short-term bonds, there will be less demand, relatively less demand, As a result, the price of a long-term bond will be less than the price of short-term bonds. Then you know that when the price declines, the rate of interest increase. The annualized rate of interest increase for long-term bonds. So that means when people prefer short-term bonds because of less interest rate risk and inflation rate risk, so high demand for short-term bonds emerge. So that means high demand means high price, that means low rate of interest for the short-term bonds. As I just explained, similarly, in contrast to this, for the long-term bonds, there will be less demand, that means less price, but their high rate of interest. So in this case, you can see that a yield curve that typically slopes upward from left to right, you can see that it will be upward sloping. So in this case, you can see that the interest rate for each bond with a different maturity is determined by the demand and supply of that bond. Then we have already discussed the demand and supply. The demand, for instance, based on that, there will be changes in the price of bonds. Accordingly, it will be reflecting upon the rate of interest. So simply to summarize this theorem here, for short-term bonds are more liquid. There is less inflation risk, less interest rate risk. That is why there will be high demand for short-term bonds, then high price and low rate of interest as compared to the long-term bonds. So if investors generally prefer bonds with shorter maturities that have less interest rate risk and inflation risk, then this explains why yield curves usually slope upward. Now let's move to the final last component, that is the liquidity premium theory. It's also called as preferred habitat theory. So an offshoot is actually an offshoot of the expectation theory by placing more weights on the effects of the risk preferences of market participants in the long term. So the main assumption here is that bonds of different maturities are partially substitute. That means they are not perfect substitutes. So in general, people prefer short-term bonds to long-term bonds. So in this case, you know the reason, the points that we discussed a couple of minutes before, people in general, they prefer short-term bonds. So if they want to, in order to incentivize them to demand long-term bonds, they need some risk premium for that. That is why the liquidity premium they need to get. That is the key idea of this theorem. So here the main idea is that interest rate on a long-term bond will equal an average of short-term interest rates expected to occur over the life of the long-term bond plus a liquidity premium that responds to supply and demand conditions for that bond. To explain this one, it has two components. According to liquidity premium theory, rate of interest has two components. The first component is this one. This is derived from the expectation theory, the first theorem that we discussed. What is the number of years? Then you take the annual rate of interest for each year bond divided by the number of years. That is nothing but the one we discussed in the first theorem, as per the expectation theory, plus the liquidity premium, because for the people to demand in the long run bonds, they need to get something additional incentive. That additional incentive is a premium. That means some top up interest rate for them to motivate for getting the long term bonds. So normally the liquidity premium is always positive because of the time period. There is a risk is there. Risk is mainly inflation risk, interest rate risk, and little bit about the liquidity as well. So this rises with the term to maturity. So here I am showing you a numerical example. So a 1 year interest rates, here what I am showing in this table is 1 year interest rates and the liquidity premium for the next 5 years. Here we are showing the first row, it shows 1 year interest rates. For the year 1, interest rate is 5%. In the second year bond is 6%. A third year bond is 7%, 8%, 9%. So what I have done here is that these are all annual rate of interest for a 1 year bond. That is the 1 year bond in year 1, 1 year bond in year 2. Like that you should read here 1 year bond in year 5th. So the liquidity premium in the first year is 0 because that is a short-term bond. But if you want to demand, instead of demanding one first year bond the first year and waiting then buying in the second year, instead of that, if you want to buy a 2-year bond today itself, then not only you should be getting the premium average of this one, plus you need to get a liquidity premium. So longer the year, the time period, the liquidity premium increases. When the maturity period increases, in general you can see that the liquidity premium also increases. So here, what is the interest rate for a 2-year bond? So to answer this one, you need to do, you first calculate the average, that is 5% plus 6% divided by 2, the plus the liquidity premium here is 0.25%. So that you can see that this is 5.5% plus 0.25%. So accordingly, you need to calculate what is the interest rate for a 5-year bond. Then you need to take the average of all these 5 years, plus then you need to add this 1%, that is the liquidity premium. So this is the graphical illustration. The first one, this one is the average premium. For example, let us see 5%, the average of each year, then you are getting the average premium here. And this one, this shaded area, you can see that is increasing, gradually increasing over time. So you can see it's increasing. So that is the liquidity premium. That means when the years to maturity increases, you can see that this also increases. That means this much is the liquidity premium, the INT. So this theory is also called as preferred habitat theory because it's a combination of the market segmentation theory and expectation theory, because investors care both expected returns and maturity. So here investors prefer bonds of one maturity over another, and investors have different investment horizons, and to buy bonds with maturities outside their habitat, they need a meaningful premium. So that means to motivate them to invest outside their preferred habitat, they need a meaningful premium. That is the additional premium they need to get if they need to invest in the long term. So normally investors prefer to park their money in short term bonds. So in order to make them to invest in the long term, so they need to get a much higher premium, higher interest rate than the short term. So that's what reason. It's actually the demand and supply forces play here. That's why in the long run, the rate of interest are high as compared to the short term bonds. So I'm just also highlighting the key findings from here. Yield curves, actually this theorem clearly explain why in general yield curves typically slope upward. This is explained by a larger liquidity premium as the term to maturity lengthens. So here I'm just highlighting some of the importance of the structure of interest rates. One is testable predictions. Second one, it gives lots of policy insights. Third, it also reflects the market expectations. So before concluding, let me show you some of the shapes of maturity yield curve. Upward sloping, the slope is less. Flat yield curve, this is inverted yield curve. Here, this is not in the general time period. This is normally happens during the recession time. So it's a signal to the recession. So this I am also showing you some figures for the yield curve for Indian government securities. This one is from July 2018. This one was August 2018. This is for the US. And before concluding, let me also have a quick reflection on inverted yield curve. Normally, an inverted yield curve is a signal of recession. So in the inverted yield curve, you can see that long-term rates fall below short-term rates, reflecting expectation of rate cuts and slowing economic growth. So signals tight credit and reduced economic activity as investors anticipate weaker growth and future rate cuts. So let me explain why would investors accept lower long-term yields. The theories that we have discussed so far, most theories they support the yield curve, that is the upward sloping yield curve. But why would investors accept a lower long-term yield? That's an inverted yield curve. This happens mainly during if investors believe the economy will weaken, their recession is on the way, they anticipate inflation will fall, that is there is an inflationary risk is there, central banks will cut policy rates, and short-term yields will decline. So as a flight to safety in this environment, investors move money into long-term government bonds seen as a safer assets. So that means there is a increased demand, there is a hike in the demand for long-term bonds, and this demand drives long-term bonds prices up, and which pushes long-term yields down. Since, as you already know, since bond prices increases, the yield declines. So this is the summary of the reasoning chain. A recession is expected, then rate cuts anticipated, investors shift into long-term bonds, then as a result is demand increases, then the rate of interest declines. So if long-term yields is less than short-term yields, then we will be getting an inverted yield curve we will be getting. So thank you for watching this video, and see you in the next session. Thank you.